A very, very good evening, friends. Once again, from the Navemarg Foundation, I warmly welcome each and every one of you all for this presentation, the masterclass, actually number 16. In the last 3 months, that is what we did the presentations continuously. Every Wednesday, we have been hosting an event like this. And the best part of it was last week, we had 2 major events. That is the event dedicated specially for the teachers on the 5th of September. And then on the 8th of September, we had the Magical Parents program, which was amazing, and the attendance was very good. We really had a massive viewership on our YouTube channel. Many of them have watched that video of the Magical Parent as well as the Magical Teacher. Those 2 events were really mind-blowing, I should say, and we had a very good response from that. Now, going forward for the month of September, we are actually preparing very much for our 2nd October event. That is the 4th Super Young Achievers Conclave, which will be held on 2nd of October, 2020. As of now, we have already done it for 3 years. That is in 2018, 2017, 2018, then 2019, we did it at Talegaon. And now this year, 2020, is going to be a virtual convention of all the college students and parents gathering together on 2nd October. And this is basically the preparation for the great Indian financial revolution, which is going to actually happen now post-COVID. Actually speaking, when I was preparing this presentation, I learned a lot of new things about how India has developed from 1947 till today. And I have actually divided it into 4 phases. The first phase, of course, is from 1947, which I will actually be explaining. And before that, it was like how the Britishers ruled over India. In fact, I should say that when I started learning this history about the Indian financial revolution, we really feel bad, like how India, which was one of the richest countries in the 17th century, landed up becoming one of the poorest countries when we gained independence. That is in 1947. And at that time, our country was so poor that whatever wealth and riches, the natural resources that we had, the Britishers and all the foreigners had actually taken it away. And that is actually how we landed up into a real trouble from 1947. And this history is what we are going to explain today. Is like from the next slide, which I'll tell you. This is what we have learned as far as the Indian financial revolution is concerned. So there are a few things which I would like to highlight here. The first thing is, where were the Indians investing post-independence? There were 2 basically classifications in this. There is something what we call it in physical assets, which comprises of houses, homes, gold, car, properties. So these are called physical assets. And there is something else what we call it as the financial assets. Now, under the financial assets, we have divided it into market-based, which is the share market and mutual funds, and the repo rate based. Repo rate is basically something very important today for today's topic. And this repo rate works in the case of banks, post office deposits, public provident fund, as well as the insurance policies. So these basically work more on the repo rate, whereas share market and mutual funds work more on the market based. So now what was the phases that we have seen as far as India is concerned? The first phase I have divided is from 1947 to 1991, which is called as the first phase. That is a phase wherein India was really, really a poor country. I will explain each phase separately. Then, of course, the second phase was from 1991 till 2016, when India started developing as a country. And then the third phase is 2016 till 2020. That is just before before the COVID virus came into India. And then from March 2020 to where we are going to head in is going to be the final phase, which I'm going to explain today as per my calculation. And this is briefly from my experience in this financial markets, what I have learned through this history. So today's session is basically my personal learnings. So you can either take it as you believe it or you do not believe. It all depends on you, because this is from my experience. And I'm personally telling, it's not that you have to take it as a gospel truth or anything of that sort. It's basically what I have felt. I'm trying to share it with all my clients here today as far as my learnings are concerned. So now let's take the first thing which I have to, you have to just clarify about this. You should understand these two words. What is repo rate and what is reverse repo rate? Now, repo rate is something wherein RBI lends money to the banks at a fixed amount of interest. So when the banks take money from RBI, they take it in the form of repo rate. And when the banks have got excess money and they want to park it with RBI, it is something what we call it as reverse repo rate. So RBI offers a reverse repo rate for keeping the excess money of the banks into the RBI. And whenever bank requires more money from RBI, it takes at the rate of the repo rate. So repo rate is the lending rate of RBI to the banks, and reverse repo rate is the lending rate of RBI, means when the banks want to keep the money with RBI. So this is basically these two definitions which you have to understand, repo rate and reverse repo rate. So if you understand these two words, it becomes quite easy for you to understand the next slide. Now, when I come to the first phase post-independence, the repo rate which RBI was giving was more than 18%. PPF was offering almost 22% post-independence. It had even touched 24% at some stage. And at that time, India was really a poor country, and the government really needed money to keep in the form of deposits and to keep up with the fiscal deficit. So the interest rates were high. People were people were offered with very high interest rates as far as PPF is concerned. As far as insurance policies are concerned, the repo rate basically was working even in the bank deposits, and bank deposits we used to get even at the rate of 22%. So this was actually in the beginning when income levels were very low, and below poverty line population of India was over 60%. This is below poverty line was over 60% in the first phase. That is from 1947 till 1991. Then after this came the second phase, wherein there was lots of reforms being undertaken by the different governments. It's like many of them were the prime ministers. Each prime minister had a different type of reforms being created. But the most important and the decisive factor in 1991 was something what we call it as the liberalization policy. And that time, Manmohan Singh was the prime minister. He was the finance minister at that time, and he had introduced this bill in the parliament. And when this bill was passed, basically we allowed foreign institutional investors to start investing in India and start combining or forming a bonding with the Indian companies, wherein they were allowed to invest and take stake of almost up to 49% and merge with Indian companies. And that is how many companies merged, like Maruti Suzuki, Hindustan Unilever. Then there are many of these companies which have merged and have come to India. And with this liberalization policy, a lot of funds started coming into India. And besides the funds, jobs were created, a lot of jobs were created. And at that time, people started actually earning money. But most of this money was actually going as unaccounted money, because the income tax collection also was very, very low. And mostly the preferred places where actually the money was being pumped in was basically the physical assets, because physical assets like flats, even properties were very, very cheap in 1991. Like once, even here in Goa, like in Margao itself, flats which were bought of 3 BHK in 1991 were costing just around 2 to 2.5 lakhs. Now the same flat of 3 BHK here will not cost you less than 1 crore. And that is how the property prices have increased drastically. But at that time in 1991, when money started flowing into the system, there was a lot of unaccounted money, what we call it as black money. And black money was accepted in real estate and gold. So people used to prefer, those who have black money used to prefer this physical assets, and those who have white money or the accounted money used to prefer the fixed deposits or bank deposits or postal or even LIC policies. Those are with the white money. But the black money collection was very huge as far as real estate and gold was concerned. So this was till 2016. It was going on very, very rampantly. And India was growing. Economically also it was growing because there was a lot of foreign investors which were coming into India. And actually speaking, even the share market was more controlled by foreign institutional investors. In the sense, the foreign institutional investors like companies from America, companies from UK, Singapore, Japan, all were investing into India. And the share market was actually dominated more by foreign institutional investors as compared to domestic institutional investors. So till 2016, this was the actual way where the people used to invest, and the interest rates till 2016 from 22% came down and touched almost around 8% in 2016. Even PPF rate which was almost at 24 at the time of independence, came down to almost around 9% in 2016. And from 2016, this is the phase when basically everything changed. That was on 8th of November 2016. There was actually a very, very big event which happened exactly at 8 p.m. when the second phase of demonetization. One demonetization was held in 1991. That was the previous one. But this demonetization brought in a lot of black money into the banking system. It was exactly on 8th of November 2016 at 8 p.m. when Prime Minister Narendra Modi had declared that this 500 rupee notes as well as the 1,000 rupee notes are no more valid. And because of that, all the cash which was lying in the hand had to be brought into the banking system, and the banks started getting flooded with money actually coming in. So when money started pouring into the banking system, automatically interest rates started falling still further. And interest rate, like on fixed deposits, started going up to 7%, then to 6%. And now in 2018, the actual interest rates, means RBI reduced the interest rate. In 2018, it was around 7.5%. And now in 2020, in the fourth phase, you will understand how actually the interest rates are still falling still further. Now, besides demonetization, another thing which happened in the same year, but it was in the month of January, there was this introduction of RERA. RERA is the Real Estate Regulatory Authority, wherein any person buying a property has to file returns for minimum 2 years. And if on those returns, you are not showing that you're earning that much amount, you cannot actually buy a flat. And second thing is the RERA regulations was put on all the builders, wherein no builder was allowed to accept cash of more than 10,000 rupees towards any payment as far as this is concerned. And also they had to give audited statements every quarter. So since the regulation started increasing as far as real estate is concerned, automatically real estate industry started going into a slump from 2016. And from that time till now, there was a big problem as far as many of the buildings were already constructed, but no sale was available for the builders. And then immediately, then again in 2016, the introduction of GST also started on the 1st of August. And with GST, automatically the tax collection started now on the expense tax rather than the income tax. And this GST was introduced for the entire population. In GST, there is no upper class, middle class, or any differentiation. It is applicable for everybody. The only thing is that whatever essential items are there, about 80% of essential items, the GST rates are zero. But anything which is a luxury item, the GST rate keeps on increasing. Like there are various slabs of GST rate, that is 4%, and 8%, 12%, and even 18% is there. So depending on that, the GST was introduced. And just before the COVID virus, the COVID pandemic came to India, the GST collection per month was crossing 1 lakh crores per month. So with that, imagine the amount of money flowing into the government system. Automatically and it's all white money. GST is all white because it has to be done online. No cash payments are accepted in GST. So automatically the economy started improving, and we started spending more on infrastructure as well as power and all the basic needs what we have for this. Now what has happened is the interest rates started lowering down more and more, and exactly when this COVID virus pandemic started, the repo rate by RBI was brought down to 4.4%. That was exactly in the month of March. The first RBI meeting which happened post-COVID virus attack, the repo rate was brought down to 4.4%, and the reverse repo rate was kept at 4%. Now, repo rate is the rate at which RBI lends to the banks, and reverse repo rate is the rate at which banks keep money parked with RBI. So what RBI said is, they told the banking people, when they told all the banks that now we don't want you to actually park the money in RBI, we are reducing the reverse repo rate, but we want you to give it in the form of loans and bring down the interest rate as far as loans are concerned. So automatically, the first thing that have got affected was the home loan came down from 8.5%, it came down to almost 6.5%. Now, banks, some of them were charging 7%, some started charging 6.5%. And now slowly, there's a pressure because we had that moratorium period which was given of 3 months. And very soon now that also will be getting over. So now the only option left for the RBI is to still further reduce this interest rates. And now with interest rates falling, keeping money for as a saving in the bank or any other form of savings, like in the form of postal deposits, or even in life insurance, all these the ones which are the traditional plans, the repo rate falling down keeps the things very, very low. The returns wise, the returns fall very low. But in what way has it affected the stock market? In the beginning, in the stock market, when the COVID virus hit, there was a major fall in the prices. Means many companies started closing down and they started falling in losses. They had to sell off their stocks, and most of the foreigners who had invested had already withdrawn this money. So Sensex fell from 42,000 mark to 25,000 mark. And what we have seen in this is post-COVID, after every month, that is on 1st of June 2020 was the unlock number 1, means unlock 1.0. Then on 1st July, we had the second unlock wherein a few industries were opened up. Then after that, the third unlock in the 1st of August, wherein most of the offices and all were reopened. And now we are just waiting for the fourth unlock, wherein even the malls as well as the cinema halls will be opened. As of now, they are still closed. We are not allowed to operate in the malls and all. But slowly, that also will come up as far as the unlocking phases are concerned. But what we have noticed is, once this COVID virus attack came into India in the month of March, now lockdown started with the COVID started in the month of March, but then February, March. But the lockdown was imposed on 23rd of March, 2020. At that time, the stock market from what was 41,306 dropped down to 25,981. You can see the sharp drop in the market prices. And this drop was almost by 40%. And from 25,000 within the next 3 months, that is April, May, June, as well as now in August. If you see the recovery of this, it has gone back to till today. If you check the markets as on today, it has touched 39,044 rupees, which has recovered almost by 40% already. Means more than 80% recovery has happened. What we thought that it would take a long time to recover, it has not even taken more than 3 to 4 months to recover whatever losses. But there is something hidden in this. And the thing which you have to be very much sure about and you have to be convinced about is this market correction is just because of a few companies which are there in the large cap sector who have managed to get a lot of foreign institutional investors pumping money into it. And just because of 2 to 3 companies which are also there as a part of Sensex, which are also there as the part of Nifty, that has created a big effect. And this market has actually, the Sensex and Nifty figures have actually increased based on these few companies which have actually shown profit and wherein a lot of investment has come into this market. But actually speaking, 99% of the companies in India are still undergoing losses. They have lost their labor force. They have lost this. Most of them are working from home. In fact, one side is the recovery is good because now the interest rates have dropped and the spending in the offices also has gone down. So now the only thing is for them to really recover. We are just waiting for the lockdown to be open to the unlock phase 4. wherein the economy and the transportation will start. Now, once the transportation of goods across the borders start, once the communication as well as the movement is concerned, once the malls and all are opened and the businesses start regaining the losses that they made during the last 5 months, automatically the small and mid caps are going to definitely pick up much faster, and large caps, which have already gained for quite some time now, in the last 5 months, will definitely pick up more. And another very, very important regulation which SEBI has put on the mutual funds is with regards to classification of these multi-cap funds. Now, multi-cap funds previously didn't have any capping. In the sense, the fund manager could put in any stocks of any kind, like large cap, mid cap, or small cap. There was no capping. But just about a week back, SEBI has put in a capping for them, wherein in their portfolio, 25% of the stocks have to be from the large cap, 25% of the stocks have to be from mid cap, and 25% have to be from small cap. So they've given time almost up to the February next year to do the reshuffling. So these funds will be doing a reshuffling, and more money will come into the small and mid cap category funds, means companies which are in the small and mid cap. So automatically, small and mid caps will also start rising up quite fast now. Instead of what we were expecting it to take at least 2 years to recover, we are 100% sure the recovery of mid caps and small caps will be much faster, and there will be a lot of money inflow coming into these funds. So nowadays, if you compare and see, the inflation figures as far as India is concerned currently is almost around 7%. It's coming to 6 to 7% is the inflation figures, and the GDP growth currently is showing negative. But let me tell you, when the GDP growth is showing negative and the stock market is still picking up, that means there is some bubble yet to be formed in this. And this bubble can happen anytime in the next, it can burst anytime in the next 2-3 months, and there can be another small correction which can happen. But what I can see from this is definitely looking forward. Now, there is no other option if you want to make your money grow. The only place where you can make your money grow is basically either by taking the guaranteed products. If you want the guaranteed products, the best are to go into bond funds, or in an insurance product where you can get a guarantee for 25 years, wherein they are giving you now guarantee that at this price, which is closing now, currently it's at 5.5% or 5.25%, you can get a fixed rate wherein they will park your money in long-term bonds and ensure that you get these returns right for the next 25 years. So if you want to park your money in guaranteed products, then you have the life insurance products which are there. But if you want to put money where it beats more than inflation, like wherein you can get returns higher than inflation, then the only option is mutual funds as well as share market. Now, if you want to go into direct shares, it is possible to actually make good profits on it, provided you know how to time the market and you know how to actually exit and capture those prices at the lowest price possible. So if you want to understand the whole concept, mutual funds is more for people who don't have that timing of the market sense and are not able to take that much of risk, whereas share market is for people who are already having more than 2 sources of income or even 3 sources of the passive income, wherein you can afford to take higher risks. So if you want to start making money grow now post-COVID or post this pandemic which has come, the only place where your money can actually grow is either through mutual funds or through shares. And if you want to have a guaranteed type of return, like if you already have a lump sum and you want to have guaranteed return, then the best thing when interest rate falls down is that bond prices go up. So always remember, interest rate and bond prices are interrelated in the sense, whenever the interest is low, bond prices go up. Whenever the interest rate goes up, the bond prices come down. So if you want guaranteed type of products, then we have to go into this bond funds or the debt funds. That we have something called debt funds. So debt funds are more for guaranteed type of returns. Equity funds, you take a certain risk, but you get a much higher returns in that, provided you stay invested with it. And if you watch our previous videos, which we have done, the videos like on Make Inflation Your Friend, that video will show you how if anybody stays invested in a fund for more than 10 years, the returns is almost more than 16%, which is 8% more than inflation. And when you get returns more than inflation, only then it is phenomenal. But if your returns is less than inflation, then automatically your returns, your units are not, the profits, you cannot see it much, but in fact, it goes down and you'll actually be making losses when you park your money in places where there is returns are less than inflation. So what I would suggest is try to take little bit of interest as far as your investments are concerned, because this is a very crucial stage wherein you can grab this opportunity of still buying the units as well as shares at a much lower price, with an expectation that post-COVID, when India recovers and travel and tourism industry also picks up, automatically we will be able to make more profits out of this with this correction that we have. So you can take this correction as an opportunity rather than a threat, provided you have full confidence that yes, India is a country which will recover. And let me tell you, from all the news, what I'm hearing, as well as a lot of speakers, what we are listening, India will be the first country to recover from this post-COVID. In fact, China has already recovered. So now India will recover very, very soon, because once the vaccine and the thing is kept under control, it is, even though every day we are seeing more and more cases coming in there, even in Goa, the spread is quite fast now. But suddenly there will be some alternative which will come. And I'm quite sure that at least once the vaccine comes and people are kept under control, this COVID virus, we have a lot of learnings from this COVID pandemic. And the main learnings that what I feel is going to be the changes as far as India is concerned is people will now avoid as far as possible luxury spendings and focus more on financial protection. Because many people have realized the need for financial protection today. Because suddenly losing jobs, becoming jobless, and putting all the money into luxury assets was actually a priority before. But now that entire thing is going to change. Now it is going to be more into savings and more into creating financial securities, because we have realized what is the power of an emergency. And when we need funds, we don't have funds. So we have to take finances into our picture. I mean, as far as managing the finances are concerned, we have to take precautions on this. And if we follow the 5 golden rules, which I have put in a video, if you can watch on our YouTube channel, the 5 golden rules are very, very simple to follow. If you just follow these rules and just maintain it just for 10 years, not more than 10 years, even then after that, it becomes very easy to go. But if you maintain these rules, and I was just doing many client meetings these days, what we have noticed is clients who started investing with us from 2008, 2009, 2010, even up to 2013, have actually made the best of profits because they didn't panic when the market fell. Who are the ones who actually panicked? Are the ones who started investing in 2019, 2018. They panicked, and many of them actually stopped the SIPs. They even redeemed the funds and booked losses. But if you had to continue with this pandemic and you had to continue investing, you would have got the units at a much cheaper price. Your average buying price would have reduced. And of course, the profits would be into. But still, we are still in the end of recovery. We have still not recovered fully. And I'm quite sure by 2021, the entire economy is going to change. So now you have to think about where exactly you're going to invest, because now physical assets have lost its charm, like especially like investing in gold and all. People have lost that thing as far as physical assets. But if you want to still invest in gold, there is gold ETFs, which are exchange traded funds. So if you feel that, but now currently gold is slightly priced higher, in the sense it is on the higher side. So if in case you feel that you want to do trading, then it's okay. But as an investment, and especially physical gold, and even now as far as properties are concerned, or as far as real estate is concerned, actually speaking, now with the interest rate falling, yes, definitely real estate will start picking up. That is for sure. So if anybody wants to invest into real estate, you can go in for it now, and especially with by taking a home loan and taking the tax benefits and the lower interest, definitely it will start picking up. And the government is making a lot of benefits for the builders also as far as the taxation is concerned, like by introducing the corporate tax, reduction in the corporate tax rates and all. So there's a lot of benefits which are coming. So just imagine the revolution that is going to take place in India, from a saving country to a spending country. Saving was basically because the interest rates were high and there was some returns coming from the saving items. And previously, before demonetization, saving used to be mostly in physical assets. After demonetization, saving came into the financial assets. And from the financial assets, instead of the repo rate linked assets, it has gone now to the stock market linked assets. So more and more people are coming into the mutual fund industry. We have seen the inflows into the mutual fund has really increased now and started picking up. And the benefit of this mutual funds as well as the stock market is we are basically participating in the Indian economy and becoming partners with all these business houses. And the more the money flows to them, the less becomes their liability. And the less the liabilities for the companies, less the interest, which automatically their profits increase more. And definitely the economy will recover very, very fast. So from my side, I can tell you like what I believe in now by looking at this, being in this financial market for the last 12 years, this was a very good opportunity. This revolution is like a real revolution which is going to happen. And I can tell you that from now onwards, post-COVID, most of the money is going to actually be invested into stock market as well as through the mutual funds, or it can be even through ULIPs. ULIPs are basically the funds which are offered by the insurance companies. So through the insurance companies, they also have fund managers. So they also start investing into the stock market. So a ULIP plan, which is offered by the life insurance, is basically a combination of insurance plus investment. Only thing is that it doesn't come free. There is mortality charge included in that. So in my way of doing, I would say that if you want insurance, please take pure insurance products. Don't mix it up with investments. Investment products is for returns. Insurance is for protection. And between the two, I always say, first get yourself protected and then only start insuring. When you start investing, because insurance is basically the foundation to your wealth creation. So the more you invest, you also need to have a security cover as far as your money is concerned. So see to it that you follow the 5 golden rules which I mentioned. And I would be very happy if all of you can subscribe to our YouTube channel and watch these videos. There are lots of videos. We have done so far 46 videos for you. During this lockdown, we have done 46 sessions, including the Sunday stories. So if you watch these videos, on each and every video, we have stressed about different aspects of finances. So if you don't start learning about this revolution, automatically you'll actually be missing the ship which is going ahead now. So take little bit of interest, and especially, let me tell you, college students today are going to be in a lot of trouble because there's going to be a lot of competition. The competition is going to be so high that on one side, the digital technology is taking over. So automatically the job cuts are going on. And on the other side, the graduates are coming out, more and more graduates are passing out. Like you take from engineering side, you take from the medical side, any professional colleges, the professionals are going to increase in number, but the jobs are going to decrease in number. So the competition is going to be very, very tough. Salaries also are going to be very, very minimal now. So you have to understand how to manage money if you want to be successful in life. So take a little bit of interest, watch those videos, especially the videos which are there on Make Inflation Your Friend. You can even watch the 5 golden rules. And of course, if you want to succeed in life, there are many personality development programs which we have conducted. As far as like Udan series was too good. Then after that, we did that the series which we did with all the other speakers. There are many of them, like Make Things Happen. Then of course we had almost, if you go on the YouTube video, you'll get all of them, because at present I'm still not recollecting all, because there are so many programs that we have done during this lockdown that we have reached out to many people. So I would wish that all of you subscribe to our YouTube channel and watch those videos whenever you have free time, and start understanding the concept of investing as compared to what it is saving. But let me tell you, saving is required for the short term. Investing is required for the long term. And only when you achieve financial independence, then will you enjoy life. So with this financial revolution, I just wanted to give in short that this way the market has offered a very big opportunity for most of us, which many of us have taken the benefit of it. And if you have not, you can still try doing it, because I'm quite sure with the way India is going to recover, you should not be suffering from that one virus, what we call it as FOMO. FOMO means fear of missing out. So you should not get that thing out afterwards once the market recovers, because from my prediction, we had done one presentation on how Sensex will cross 50,000 before December 2021. So by December 21, where we are now, I'm telling you, the whole thing will change. So try to take the maximum benefit out of this opportunity which has come. And this financial revolution is definitely going to make India a much more richer country as compared to what it was before. So whatever we can say that before independence, we were a rich country. now after independence, we are also going to become one of the richest countries, because as of now, as far as our GDP is concerned, we are the fifth ranking country as far as the GDP is concerned, and slowly we'll definitely start picking up. And I'm quite sure by 2022 we should be somewhere in the third position. Of course, first position currently is USA, second position is China, and now very soon we as Indians should be going to the third position very fast. So let's try and be a part of this financial revolution. Start investing. Don't allow money to sleep in the banks. Don't allow money to sleep in the saving account and growing just at 3% interest. Because now keeping money lying idle will not help your money grow. So if you want to help your money grow, you need to invest, but invest through wise chances. So we have, like, through experience, we can tell you like which are the funds which you can invest in, and try to accumulate maximum units possible during this time when the things are available at a lower rate. So if you have any questions, you can put it on the chat box. On the YouTube chat box also is open. So you can just put in your questions and let's answer them. Okay, or you can even unmute yourself if you are there on Zoom. You can unmute yourself, and if you have any questions, any doubts with regards to this, I can say that if you can ask any questions, free to ask. Okay, no questions. You can still put it forward later on. There's no problem. We will end this program for today now as on today. And we will try and organize one sec. Okay, there someone who wants to speak. Yeah, Joe?
Yes. Why were the interest rates at 24% before 91? What was the reason?
No, that time India was a very, very poor country. And any country which is poor, always the interest rates are high because the government borrowing is much more. So what happens is whenever the government borrowing increases, automatically the interest rate goes up because they wanted actually money for the reserves. Because before independence, the Britishers had actually almost drained out all the reserves as far as India is concerned. And then at that time, the interest rate was very high. And you can ask anybody who has been there before 1990, even say in the year 1980, what was the rate for PPF and all. You can check it out on the Google also. It is showing that it was in 1980, it was actually 22%. And
Yes.
then it came down to 18%, and slowly now it has reached up to almost 5%.
But don't you think that with 24% interest rate, the economy will get killed? All corporates will get no chance to grow with such high interest rates?
Because of that only, the Indian economy was not growing, and all the money was actually pumped in by the foreigners at that time. And because of that, India was not growing. So now the interest rates have been brought down quite a bit. And only once the interest rates started falling, the economy started growing.
What about in US and all? Interest rates are almost zero.
Yeah, now it's
also
completely
goes to
zero.
zero.
Yes, because we also might reach there, but not so fast. It will take at least another 10 years to reach to that level. But 100% it has to come down to zero, because all the countries where the inflation is almost negligible, the interest rate is almost zero now. And especially now post-COVID, they have brought it down quite a bit. Like Canada, it is negative. Japan, it's negative. Not even one. It is minus if you keep money in the bank now. There they will charge you for it. The US
Yes.
has come down to almost zero now. UK also is just on 1% at present. If you go to UK and all, your bank deposits and all are just giving you 1%, not more than that. So
Right.
India also will be going to that stage, but still it cannot go in one step only. It is slow and steady. And with these reasons which have come with the COVID pandemic and all, definitely now it's going to go much faster. We were expecting home loan rates with, like, I can remember when Modi took over as the prime minister first time, he had that vision of housing for all by 2022. And in that speech, when he said that home loans should be available at 6%, by 2022, his vision was to make affordable housing for everyone. And by giving home loan rates, bringing it down that interest. So now, if a home loan rate comes down to 6%, your fixed deposit rate cannot be more than 4.5%, because there has to be a margin for the banks to make profit. They cannot keep on making losses. It cannot be equal. So always a home loan and a fixed deposit, the interest rate difference has to be minimum 2.5%. So now to bring down the home loan to 6%, your fixed deposit rate has to come down to 4.5%. and there is a vision, and this the government wants to have that housing affordable, because after demonetization, a lot of especially the real estate industry and even the other industries have come, means the businesses have stopped, especially the infrastructure companies. So because of this, now now this was like a very good opportunity to bring down the interest rates. So now once the interest rates are brought, I don't think they're going to be increased again, unless India becomes a very poor country again, which is there's no chance of it.
One more thing. One is, in Germany and so many European countries, the interest rates are negative. That means bond prices are well over 100%. Why would investors invest in a bond when the interest rate is negative? They actually lose their capital. It doesn't make sense, right?
No, see, bonds are basically when you're lending your money to corporates, and that corporate gives you a higher interest than what the RBI gives you. So bond rates are basically more of it's like there is a formula what we say that as the interest rate goes down, the bond prices go up because the lending has to be there. So that is but now when I was checking the GDP growth as well as the interest rate.
Why are the interest rates are negative in Germany and European countries? Why would any investor buy bonds when the interest rate is negative and he will lose his capital every year?
Yeah, but now that's what. So now what happens? The countries which are developed. Now, the countries which are developed already, like Germany and all, now that they don't offer much of the bond prices. The bond prices are almost negligible. So people there, they don't have any chance of savings. See, now what has happened in most of the countries, the interest rate as well as bond prices falling down, the only place they can pump in their money is into India, because India is the only place which accepts all foreign investments, and the only restriction now put is on America. So now any American or any US citizen who wants to actually invest in India has to file returns at both the places. So there is you have the restriction on only the US and the Canadian citizens. They're having a lot of restrictions as far as India is concerned, but the rest of the world can invest into India and put into any mutual fund anyway. Except, of course, now the restriction is because of that they started with that FATCA declaration, wherein you have to declare if you're a taxpayer in any other country. So that regulations are coming very strict as far as India is concerned, as far as the investments also. So now the taxation rules also are changing, wherein now without filing returns, you cannot buy any property more than 2 lakhs or do any investment of more than 2 lakhs. Because if you do any shopping or if you buy any item which is more than 2 lakhs, automatically income tax sends you a notice if you have not filed your returns. And that notice comes within 5 to 6 days. It comes by speed post. It comes directly to your registered address. So filing returns is becoming now more and more compulsory if you want to buy something worth more than 2 lakhs. Like say, suppose you're buying a car and you have not filed your returns. Automatically, you'll get a letter coming to your house within 5 to 6 days. Same thing if you buy a house and you have not filed your returns. You'll definitely be under the income tax scanner very fast. So now the regulations have changed. So automatically now the only place where you can actually get almost like with the reduction of tax and all. And why I actually like mutual funds as well as the shares is you pay tax only when you sell it, not when you hold it. If you hold that amount, there is no tax. It is only when you sell and make a capital gains out of it that you have to pay the 10% tax. And 10% is uniform for all the tax slabs. And that also only if your capital gains on the sale for that year crosses more than 1 lakh. If it is less than 1 lakh, it is tax free. And this happens, the taxation is only when you sell a huge amount, like you sell a property. But if suppose you're doing on the monthly systemic withdrawal, like if you're withdrawing even say 1 lakh from your 1 crore portfolio, withdrawing 1 lakh per month, you're only selling that many units. So your capital gains, if might cross slightly above 1 lakh per year, but even on that, you're paying just 10% tax as compared to keeping money in the banks and paying TDS just for holding it, not even for removing it. For holding it there, you're paying tax. Like if you have a fixed deposit, say of 20 lakhs or 30 lakhs, every 3 months, your TDS will be cut. So TDS is cut on the interest. Whereas here, the taxation is very, very liberal. As far as mutual funds and shares is concerned, it's totally in a different way. It's only when you sell that you pay the tax, not when you hold it.
Yes. Okay.
Yes. But very good. I'm very happy that at least we got one question, because at least we could start a debate. So I must thank Joe especially, because this is actually what brings life for a presentation. When you ask questions, then only we know where the direction is. And so I must thank you very much for asking this question. It was really very good session. And at least this has helped many others, because see, with your questions, I'm sure many people also were not aware about it. So it has added a lot of what is yeah.
One more question. The US has printed trillions of dollars to boost the economy.
Yes.
How come the US dollar is still going up? It should have fallen.
Okay. Now, now I'll tell you exactly how the US dollar actually affects Indian economy. Now, what happens as far as Indian economy, the dollar price is calculated based upon how much we import and export. Now, what happens is our major import is actually crude oil. And on that, the crude oil prices have fallen down, but the dollar price has gone up because we are still importing quite a lot of material from the outside. And of course, because of I should say, this economy, how it has got corrected, definitely it has still remained. The dollar price has still remained at around 72 something. I can't exactly remember now, but it is going to pick up still more, because India is a country which imports more than what it exports. So when exports is less than imports, automatically the price goes up as per the calculations how we have found out. And dollar price will keep on going up. And actually speaking, investing in currencies also has given a lot of profits for many investors, because currency is also another mode of investment. And holding on to this currency, like if someone had to buy dollars just around 10 years back, say around $1,000, the profit is almost double within, not more than, it has become more than double from 30 rupees, which it was there 10 years back. Today it has gone to 72 rupees. So investing in currencies also is worth it. But main thing you have to see, like the risk is also slightly high.
Right.
So any other question, anybody, any other participant, even on, okay, here the one question I've got on the YouTube. What about entry of capital gains in income tax returns? Okay, very good question. Now, as far as your income tax returns are concerned, every year, in case you have invested into mutual funds and you have done any redemption, only when you do a redemption, then you have to give it along with your profit and loss statement, and whatever the profit and loss gets reflected on your Form 26AS. So whenever the chartered accountant or you are filing your returns, you have to refer to Form 26AS, which can be downloaded from the income tax site. And on that, all your transactions and sales which happen in the mutual funds as well as shares, it gets reflected, and your long-term as well as short-term capital gains tax gets reflected on that statement. And based on that Form 26AS, you have to file your returns. So as far as the capital gains in income taxes, it comes directly on your Form 26AS. So you can just download it before filing your returns. It comes. And if you want from us, on our software, we can actually download, and it affects only if in case you have sold any units. Or in other words, it is called redeemed. If you redeem any units or redeem any shares, only then the tax is applicable. Otherwise, there is no tax on the entry. In the sense, when you invest, there is no tax. But only when you redeem, if it is less than 1 year in equity, it is short term. Whereas in debt, it is less than 1 year, less than 3 years is short term. Whereas above 3 years in debt, it is long term, and above 1 year in equity, it is long term. So the long-term capital gains and all can be calculated easily, and you can get the download directly from the income tax website. You just have to put your PAN number, register your mobile number and your email ID. Once you get the link, you will get an OTP. And through that OTP, then you can download this form easily, Form 26AS, which comes at the end of each financial year. And that is the form which actually the CAs refer to.
Yes, about gold and the stock market, they normally move in opposite directions, but this time both have been going up only. This is a very contradictory situation. Always gold goes in the opposite direction of stock market.
Actually speaking, yeah. Now the thing is, actually speaking, the stock market has still not gone up. It is basically just the bubble which has come as far as stock market is concerned. What has gone up are the gold prices. Stock market has actually come down. But just because of just 2-3 companies, the Sensex and Nifty are showing up. But actually speaking, the market has still not gone up. Market is yet to recover. Market has still not recovered completely. It is just few companies which have really made the profits now in the last 2-3 months. And major contribution is, of course, because of Reliance Industries. Reliance Industries was very lucky to get a lot of foreign institutional investors putting money in and huge amounts in that. So because of that inflow, and since Reliance is a part of that benchmark, in the sense, in Sensex has got 30 stocks in it, out of which Reliance is one of them. Same thing, Nifty also has got 50 stocks in it. And this is basically I should say like a comparison chart, like a benchmark. It's not the exact Sensex of means exactly feel of the market. It's just like a benchmark. And why this benchmark is created is so that like even these fund managers have to actually beat the benchmark when they're performing. So Sensex and Nifty are basically two benchmarks. They are nothing related to this in the sense in the individual stocks. But now why it is shown, this is because of few of the companies, and out of which Reliance is one of the major ones. Even Infosys has got some lot of money flowing in. And of course, lot of domestic institutional investors have started pumping money into mutual funds. And from mutual funds, the investments have started increasing into the stocks. Because the difference between an individual person, like say a person like me investing and a mutual fund investing, we will invest in thousands where they invest in crores. So when they have got that stock allocation and they put say around 100 crores in a company, and especially when they buy the companies at a very low price, like I'll give you my example. When I was investing in Apollo Tyres, suddenly I got a chance to buy it at 70 rupees. From 220 rupees, I bought the shares at 70 rupees during the lockdown. And that is how I brought down the average, and automatically now I'm making profits in it. But that's because I can put in huge amount of money now, because we are reached to that third phase wherein already the passive income is there. So once you are able to generate this type of alpha on your investment in stocks, automatically you can get actually the returns. Main thing is the security should be there, and you should be able to be disciplined. And the main goal in investment planning is basically just to see that you're financially secure.
So now you think gold will go down as the stock market starts going up?
Now, actually speaking, the demand for gold will be lower now, because now it is very expensive. So it might go into a different phase, because now silver might start picking up. It all depends. There are phases for it. But if you want to save it as a physical asset, it is actually not going to generate any returns for you, because see, these physical assets are more on emotional basis. So like when you buy gold, you'll sell it at the last only if you go into crisis. But if you just leave that gold in the bank, it is not going to give you any returns. It is just that it is there physically, unless you sell it. But selling is only in crisis. You will not sell gold unless there's a crisis. But keeping it in the bank and just keeping it in locker, I don't think it's going to generate any returns for you. So now the youth and the youngsters have already started feeling that this. So now the demand also will start reducing because the prices have gone up. But if the prices fall, again, it might pick up. Because currently now they're finding difficult, and especially now because of this COVID pandemic, it's going to be the sale of gold, and for goldsmiths and all is going to be slightly lower now. But you can't stop it, because the Indian tradition always says that yes, gold is required for your marriages, gold is required. So that investment will still come more because of emotional attachment. But as an investment, I don't think it will make any difference as such.
Right. So these gold loan companies are really looting the public. They're getting gold worth 1 lakh and giving 75,000 cash plus getting 18% interest on that.
That's what. Definitely. The interest rates are very high in gold loans.
They're looting the public. Yeah.
Definitely. It is 100% true, because I feel it's actually looting, because blocking that gold and keeping there. And then now even the government is giving this gold sovereign bonds with an interest of just 2%. And they are giving you as per the capital appreciation. They are not giving any guarantee other than 2% interest. So whatever price you buy now, after 8 years, if the price is low, then you lose that. But only thing you're getting this guaranteed interest of 2%. That is the only thing which you get in this. But the worst part is this interest is again taxable. It gets added up to your taxable income. It's not a tax-free income.
Okay.
And so is one question here, that is, if it's not reflecting in Form 26AS, if it doesn't reflect, then it will come from the mutual fund statement itself. But actually speaking, if you have not done any redemption, it will not reflect on your Form 26AS.
What is this Form 26AS?
It is the form which is issued by the income tax as per the PAN card. And it gives you all the transactions, what you have done for the year, like how much of TDS has been cut from your salary, how much of TDS the bank has cut. It all gets reflected on this Form 26AS, because whenever an employee gives a salary, his tax has to be calculated and it has to be put as per the PAN card. So the entry is made, and Form 26AS generates the entire TDS history of this, plus if there are made any long-term or short-term capital gains on it. And it becomes like very easy for the chartered accountants to file your returns, because that is the actual legal document.
But is STD also shown in that?
Yes, even STD is shown on that. It comes in that form.
Okay.
Okay, so I think we should end for okay. In fact, I feel that next Wednesday we should have like this on Nivesh Patshala, wherein you can keep on asking any questions. So if I will send it on the group also, if anyone wants to ask any questions, we can have a discussion, but we'll do it on face-to-face basis. Like we'll put the cameras on and we'll try and see some any discussions if you can do. Because I'll tell you now today from today's presentation, I feel that post that financial revolution, this was much more interesting as far as answering these doubts and questions are concerned. So I'm very happy that, and especially to Joe, who started the conversation, and then on the YouTube channel also some comments and sharing has come on this. The questions, I must say that ESD, who is one of our students, has put that question very with regards to capital gains on income tax. So if you have any doubts with regards to your investments and all, you can ask anytime. We will try and learn from it. If in case I don't know anything, I will definitely make a research and get the things done, because we are very, very passionate about the subject. And we want to see that each and every one of you doesn't lose this opportunity of investing and doesn't say that, okay, no one told me about it. I was not aware about it, about this taxation. I was not aware about this returns part of it, inflation part. So any questions, if you have, you put it, and then we can discuss it in the next meeting when we have, preferably on next Wednesday. And I want all of y'all to actually be part of our Super Young Achievers Conclave, which is going to be on 2nd of October. And luckily, Mr. Shiv Kera has almost confirmed his participation. I don't know, most of y'all should be knowing Shiv Kera. He's the author of the book, You Can Win. And he is my mentor, I should say, because when I read his book for the first time, I really found that book, You Can Win, is too good. And it has really improved my life also. So I told him, and once I even met him personally in Delhi, I had gone to attend his seminars, and I had taken his autograph, and I said, yes, because of your book, I really love it. And I have all the collection of his books, and he has agreed to actually, only thing he has still not confirmed the timing, because he will be speaking from USA directly online on our YouTube channels as well as our Zoom channel. So only the timing is left to be confirmed. But as far as his participation, he said, yes, he will definitely be there for our program on 2nd October. And we want maximum college students to attend this program, because if you want to be successful, this program will change your life, because he'll be able to tell you what are the factors that actually make you win. And it's like it's there already in his book. But when he gives you live that this testimonial and his explanation, I'm sure it will get convinced. Many college students will definitely love that program on 2nd October. And it's going to be our fourth fourth Super Young Achievers Conclave. Last year, we did it in Taligaon. We had a gathering of more than 480 college students. Year before last, we had done it at Ravindra Bhavan, Margam, with more than 800 college students. And in 2017, we had done it at Ravindra Bhavan only. There also, we had almost around 300 college students coming, attending the program and taking a pledge to be financially disciplined. Last year, it was really done with the full video recording at Taligaon. We had even our CM coming and addressing, but he did it by video conferencing because last minute this delay was there. So we did a video conference call with him, and he was very much happy that financial literacy is included in this program. And today, let me tell you that even the Goa Board of Higher Education has approved our syllabus, and we are actually going to start a pilot project now this year. We are trying, last year itself, I had done this financial literacy internship program in 9 colleges. And many of the students took benefit of this. And luckily today we can say that, yes, we have more than 800 college students who are less than 21 years of age who have started investing with the goal of becoming a millionaire by 25. Because our aim is they should be financially independent, and that also in India itself, because it's not difficult to grow rich in India, provided you know how to manage your money well. So if you manage your money, success is yours. So this is the mantra what we give at Navemarg. So I would thank each and every one of you for being a part of this. We have completed exactly 1 hour from the time we started. So thank you for spending your time and being online with us, either on YouTube, there were many of them, plus even on Zoom. And if in case you have missed any of this and you would like to see it again, please, you can watch it again. It will be there uploaded on the YouTube channel. You can actually watch it anytime you want. So please do subscribe. And if in case you want to receive the further notifications, that is something very beautiful. Just click on the bell icon. And every time we are live, you'll be getting a notification and you'll be reminded that, yes, this program is starting in another 5 minutes. So you'll not miss it. So just click on that bell icon and get the notification, because there are lots of programs happening through the YouTube channel now. And almost on a weekly basis, you can learn something different, because there's no topic which has been repeated. It is always a different financial topic. And from each seminar, even if you learn one sentence or one idea, that itself makes it beneficial. So on behalf of Navemarg Foundation, I would like to thank all the participants for today's program. It was a pleasure for me to have this program after the Teachers' Day as well as the Magical Parents program, which we did. And this was like a preparation for the great financial revolution, which is going to happen now after the Unlock 4 phase starts. So please take interest in your investments and start investing smartly. Thank you.
Thank you so much.
Thank you. Yeah, thank you.